This one simple investing mistake is the single largest reason why the overwhelming majority of investors don't make any significant profits in the stock market. And worse yet, it causes others to actually lose money consistently year over year by attempting to invest. What's going on? Hi everyone, my name's Ben, and this channel is dedicated to all things personal finance, helping you earn more, spend less, and invest the difference. Now today we're going to be looking at the single biggest mistake that the majority of investors make. As investors, we like to think of ourselves as relatively smart and relatively intelligent, good, sound, fundamental investors, but the reality is far different. The reality is we are all human and we typically process things primarily based on emotion, especially when the outcome is super important to us. Look guys, I know you guys work hard for your money, and so nobody wants to lose money, so the thought of losing money is terrifying for a lot of people. And likewise, people have these grandiose fantasies about becoming an overnight millionaire, right? Like everybody wants to hit that one perfect stock that goes through the roof and suddenly their life is forever changed. I mean, how many people, when the lottery hits 500 million or $1 billion, how many people sit and fantasize at work all day what they're going to do when they win that money? And so when they're investing their money, they don't want to lose their money. So at the first sign of trouble, people start to panic. They will lose their mind as soon as they start to lose money. And on the flip side, when they start gaining money, they get a false sense of security that since the stock has been rising, that it will continue to rise forever. So what typically happens with a company is if its stock price is really low, the company is not doing very good, nobody's talking about that company, right? Or if they are talking about it, they're talking about it in a bad way. And so nobody wants to buy a bad company, so when the price is super low, you're not interested in buying it because there's nothing but bad things to say about it in the news. And then it starts to make a little bit of money, it starts to progress a little bit, and at some point, as it's going up in value, it's gone up now enough in value that people are starting to take notice. Your friend at work, he wants to brag to people about how smart he is and what a great investment he made, so he's make sure to tell everybody in the office just how smart of an investor he is. He bought it down here and now he's doubled or tripled his money or whatever the case may be. He wants everybody to know how smart he is. And your neighbor across the street, they're telling you how great they did in that particular stock. And as the price continues to go up even more, now it starts to gain national attention. You start to hear about it on the news. You start to see it on finance channels. Like now everybody's talking about this stock. It's sort of the buzz of the town. And so as more and more people start to talk about and hype this company up, you start to think, wow, like this must be a really great company. Like everybody seems to be making money on this company. Everybody but me, it seems like. Like I don't want to miss out on that. I want to make money too. And this, ladies and gentlemen, leads to a concept called FOMO, or otherwise known as the fear of missing out. As the stock price rises, those people around you that actually invested on that stock, they tell you how smart they are, and so you want to jump on that bandwagon too. But realistically, the stock has usually already made the overwhelming majority of its gains at that point. Like you should have bought it down here, and you bought it way up here because of the hype. Now maybe it continues to go up a little bit more, and you start to think, wow, I'm a genius. I must be the smartest guy in the world because I bought this stock too and it's kept on going up. But this is how bubbles are created. Legendary investor Benjamin Graham famously said that in the short term, the market is a voting machine, but in the long run, it's a weighing machine. Meaning that in the short term, the price of a particular stock is really nothing more than a simple popularity contest. How many people are interested in buying this stock? Because the more people are interested in it, the price continually gets jacked up as more and more and more people want to partake in these supposed profits. So what happens is the price has hit a peak, and the company, realistically, the underlying fundamentals of that company do not support this price point. And so at some point there's going to be a drawback, and usually it's relatively significant, and the price is going to start to plummet. Now, as the price is going down, you hit your break-even point, right? Like, this is the price that you bought it at, and it had gone up a little bit. Now it's kind of retraced a little bit, and it's back to where it was, and you start to get a little bit worried, but you're like, all right, that's fine. I'm still breaking even on this stock. Everything is going to be all right. But then it keeps going down and down and down, and you start freaking out because you worked super hard for your money and you start panicking. And so you start smashing the sell button on your Vanguard account or Robinhood or Fidelity or whatever. Like, you can't get rid of this stock fast enough because you're just bleeding, you're hemorrhaging money at this point. So effectively, what you have done is you have bought the stock at close to an all-time high when it was driven up purely by hype. There was no fundamental underlying conditions causing the price of this stock to be that high. It was simply a hype machine. It was a popularity contest. And so you bought it super high and then the price dropped lower and you panicked and you sold. So you lost money by investing. And then more often than not, the price of that stock that you sold, now super low, starts to come back up because the fundamentals of the company dictate that it should, in theory, over the long run, be priced at a certain point. What smart investors were doing is they were buying the dip. When the stock price plummeted and retracted, it usually goes significantly further south than what the company's fundamentals warrant. So it's these emotions of trying to jump on the bandwagon of the latest hot stock and ride that wave to fortune and glory. And then when things go wrong, people flip out, panic, and sell their assets at a loss. Instead of investing based on emotions, you should always base your investing on good, sound, fundamental practices. And one of those practices is not to buy into the hype. By the time you hear about a stock on the national news or your best friend next door who's not an investor, he suddenly starts talking about this particular stock, that's the time that you need to start running away. You need to sell this stuff as fast as possible because more than likely the price is gonna start plummeting because it was just hyped up. Now, if you like the company, then chances are in a few short months, once that price has plummeted, now you might be able to actually buy and invest in the company because when the price plummets, it's going to drop hard. And so when the price hits the bottom or when you think it might be close to the bottom, that might be a good time to buy into the company if the company is actually legitimately profitable. But taking the emotions out of investing is super hard because, like I said, we all work so hard for our money. Fidelity famously did a 10-year study of all of the account holders that they had. These are millions of different accounts. And what they found over a 10-year period is their best investors are dead. Yeah, like literally, they're dead. What they found was the accounts that over the 10-year period averaged the highest rates of return, the user, the controller of that account was either dead or inactive. Like, they just didn't make any trades. They didn't invest in the hype. They didn't panic and sell. They just left their stuff alone. They did not invest emotionally. And I mean, if they're dead, they didn't invest at all. Like, everything was just letting the market do its thing. A great example of riding the hype train might be a few years back. In October of 2018, Canada legalized marijuana. And so if we look at the stock price of Tilray, now Tilray was a pretty new company. It basically just opened up once the news hit that, their Congress had passed this law saying that marijuana was going to be legal. And so you can immediately see that the stock price skyrocketed. Like, everybody around this time was talking about how Canada had legalized marijuana. And everybody was buying weed stocks. Like, every Robinhood trader was buying Tilray and Aurora Cannabis and a few others. Like, the price of these things was skyrocketing. But realistically, these were brand new companies that faced significant problems, both with being a new company themselves and new government legislation. Like, these companies didn't have a supply chain, they didn't have a distribution network, they didn't really have anything. They're starting from scratch, and so these companies were not profitable, and the prices plummeted. These companies were purely based on hype and speculation. The underlying company just did not support the extreme valuations that these stock investors were placing on them. Another hot stock that everybody seems to be talking about that personally I wouldn't touch with a 10-foot pole is Tesla. So currently Tesla's market cap is larger than the 9 largest automakers globally combined. If you want to see just how crazy Tesla's market cap is right now, just take a look at this chart showing their market cap as a ratio of how many cars they've actually sold. Now I get it, Tesla makes some pretty cool cars. Like, I personally wouldn't mind owning a Tesla, but just because I want a Tesla car doesn't mean I want to invest in Tesla the company, because currently the company is super overpriced. But all you hear on the news is how fantastic Tesla stock is doing, how everybody's getting rich, how Elon Musk is the richest person in the world. Like, all you hear about is this great stuff. But like I said, guys, when all you hear is good stuff about a particular company and how their price is just continuing to skyrocket, that's the time to run. Because emotions are weighing in on investors and they're buying in on the hype. They don't want to miss out on those gains. So instead, guys, you want to zig when others are zagging. When everybody is trying to buy Tesla stock, you want to be the one selling it to them, because now is the time to get out. And when everybody is running for the hills, scared to death of maybe the airline companies or whatever is going on with coronavirus, that's the time to buy. If you like this video, be sure to subscribe, leave a comment down below, give it a thumbs up for the YouTube algorithm, and as always, I'll see you all again next time. Thanks.